So what happens when the world's second largest economy gets a warning that its entire playbook for success is, well, running out of time? That's not a hypothetical. It's exactly what just happened. We're going to break down the urgent message the International Monetary Fund, the IMF, just sent to China.
And look, this isn't some dry, technical update that only economists care about. No, this is a message that could genuinely shake up global markets and totally reshape the future of world trade. The stakes here are incredibly high, and I mean for everyone.
All right, so what's really at the heart of this problem? For decades, China's incredible rise was powered by this one massive engine, basically becoming the world's factory and exporting everything, everywhere. But now, the IMF is saying that very engine, it's starting to sputter out.
And the contrast between then and now is just stark. You had the old model, the one that made China an absolute economic titan. It was all about being the world's factory, with growth just fueled by exports. But the new reality? It's a whole different ballgame. We're talking rising trade conflicts, supply chains shifting all over the place, and global tensions squeezing that old strategy from every direction.
Here's the bottom line. The global environment that created China's meteoric rise, it's just not there anymore. It has fundamentally changed. Other countries are actively trying to diversify their supply chains. They don't want to rely on one place. And frankly, global demand just isn't what it used to be. The world is moving on.
And this is why the IMF is using such dramatic language. They see this whole situation as a ticking clock. It's not a suggestion, it's a direct warning that China is running out of time to pivot its entire economic strategy before it starts facing some really serious consequences.
But, this is where the story gets really interesting. Because while all those external pressures are a big deal, the IMF argues they aren't even the biggest threat. The real danger, it's brewing inside China itself.
Just think about that for a second. All those headlines you see about trade wars and global politics, according to the IMF, that's almost a distraction. They're secondary to a much deeper, much more complicated problem happening at home.
So what are these internal headwinds? Well, it's a perfect storm, really. You've got a property market that's been severely weakened. You have consumer confidence that's just cratering, a population that's aging fast. And what's the result of all that? Millions of families who are simply too worried about the future to go out and spend their money.
So you have to ask, what's the consequence here? Well, the IMF is warning that if domestic spending doesn't rise to replace that slowing export engine, China's economy could slow down way faster than anyone is expecting. And that would make it incredibly vulnerable to even small shocks.
Now, given these massive challenges, the IMF isn't just ringing the alarm bell and walking away. It's actually proposing a solution. And we're not talking about a little tweak here and there. They're calling for a complete, fundamental economic pivot.
So here's their roadmap. It all starts with boosting the income of everyday families. Then you expand social protections, the social safety net. The idea is that with more security, people will finally have the confidence to spend money instead of hoarding it. And then the final crucial step, empower private companies to drive that new domestic growth. And really, the heart of the issue is this. When people are worried, they save. And in China, the household savings rate is incredibly high compared to other major economies. The IMF is saying that unlocking all that saved-up cash and turning it into spending is absolutely essential.
The ultimate goal here is something you could call a great rebalance. It's about shifting away from an economy built on massive, state-led projects and just producing things for the rest of the world, and moving towards an economy driven by private sector innovation, focusing on domestic needs and selling to its own 1.4 billion people. I mean, that is a monumental shift in thinking.
So, you might be sitting there in Europe or the Americas thinking, okay, but why should I care about China's domestic policy? The answer is simple. If China's economy slows down, the entire world feels it. Let's break down exactly why the world is holding its breath.
The reality is, China is woven into the very fabric of the global economy. It sits at the absolute center of countless supply chains. I'm talking about everything from the phone in your pocket to the car you drive. A major slowdown there could reshape international business almost overnight. This chart lays out the potential domino effect pretty clearly. A slowdown in China? That means immediate disruptions to global supply chains. It means volatility and uncertainty in stock markets all over the world. And ultimately, it would act as a major drag on the entire global economy. That's why this matters to all of us. Which brings us to the final multi-trillion-dollar question. Is Beijing going to make these difficult, fundamental changes the IMF is calling for? Or will it just double down on the old export model that brought it so much success, even as the world changes around it? Whatever China decides, its next move won't just shape its own future. It could very well rewrite the rules of global trade for decades to come.